Hello, traders. This is Wednesday, last day of April, April 30th, 2014, 8 a.m. Chicago time. Thanks for joining. Trading futures, options on futures, and foreign currency involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. So, as expected and talked about a couple of days ago, today is full of um, market news, numbers, and things like that. Early today, we had European CPI, which came out at 0.7% versus 0.8%, showing that inflation is not picking up as the ECB is trying to push for that. And then we got GlaxoSmithKline reporting at 6 a.m., reporting at 0.21 British pounds in line. And then later on, we got U.S. ADP employment change at 220 versus 210, so a little bit better than expected. and then GDP came in, the annualized GDP Q on Q for first quarter came in at 0.1% versus the expected 1.2%. So we saw a drop in the S&P from about 1873 to about 1868.50. Quick drop and a small recovery since. The S&P is trading the mid of the session, currently on a very, very balanced profile. We'll look at that in a second. U.S. employment costs index came in at 0.3 versus 0.5%, also lower. And then looking ahead, we have at 8:45. By the way, this number comes out to subscribers sooner. There are always rumors on the number before it comes out. But at 8:45 Central, we expect Chicago PMI at consensus of 57.0 for April. It could come out as early as 8:41. I've seen it come out earlier. This is a fairly important number. It's a purchasing managers index. At 9:30, we have U.S. crude oil inventories expected at 1.1 million barrels. Distillate inventories at plus 500,000 barrels, and U.S. gasoline inventories at negative 950,000 barrels. And then, of course, we get, so that's at 9:30, and then from 9:30 onwards, we have no releases until the key release of the month, which is the FOMC rate decision, expected to stay in line at 0.25%, 25 basis points. That's at 1 o'clock Central, 2 Eastern. And then we'll hear about the Fed QE3 pace, expected at 45 billion. So today has a lot going on, and then as we look for what else is on deck as far as speakers and so forth, we have Bank of England's Dale and Haldane speaking in Parliament at 10:30 Central. Probably not going to affect the U.S. much, but we also have ex-Fed Speaker Bernanke at Brookings in Washington, speaking at 2:30, so it's about an hour and a half after the Fed release. Ex-Fed President Bernanke is going to be talking in Washington. Not sure what to expect there, but other than that, we don't have very much on deck as far as auctions or anything else for that matter. So today, pretty important release coming out at 1. In addition to the one at about 8:42 to 8:45 this morning. So I expect the opening trade to be fairly choppy and without direction until PMI, and then the market direction will become more obvious at that point. Let's look at the charts. Actually, let's look at German unemployment change came in at negative 25,000 versus negative 10,000 as well. So a few new items that affected the euro movement. The euro's been rallying since the open. It dropped and then it rallied on the European CPI news and so on, and it's been rallying since. It was further buttressed by a poor GDP release in the U.S. Pushed as high as $1.3871. Yesterday's high in the euro is 138.77 on the UK-US session. So let's look at the charts here real quick. This is the overnight session or 24-hour session on the ES. This is yesterday's trading. Yesterday open, tested higher, tested lower, and has basically built a what is considered a P-shaped profile, short covering type profile. It's fairly balanced. The value area of yesterday's profile is valid. Overnight, we didn't really do much. We pushed down to 66.25, retested 66.5, and then rallied up to 73.75, and then fell on the GDP news. The rally was the result of the ADP release for employment. Don't forget, it's Unemployment Friday this Friday, so the ADP kind of forecasts that a little bit, although it hasn't been very accurate in the past. But overall, we have a pretty normal distribution on the overnight session. Fair amount of energy. 69.50 is the VPOC. The market's trading and holding above it. To me, it still looks like we're likely to continue higher to yesterday's targets, which were 76.75, 1876.75, and 1881.50. So the overnight session is telling us that there's a fair amount of volume. We have 192,000 with approximately 20 minutes to go. The expected, or what's considered the most common amount of volume for the overnight session in the ES is about 225,000. So it's a little bit short, but it's definitely stronger than it's in the last few days. Something I want to show you. This is a weekly. It says monthly on the title here, but change it to weekly just for now. This is a weekly market profile chart showing us what the market has done week by week, and essentially what we have is the month of April being more of an exploring month. Prices explored lower down to 1803 or 1807 or so, and then came right back up to push back into and above all of March's high volume area, 64.50 being the controlling price. But then over the last couple of days, what we've done is we've explored down to 44. We were not able to get down into this area where I see weakness in the profile that I talked about yesterday, and we got within 4 points of it before we found buyers, and then have put in another P-shaped profile showing us that the shorts are likely getting squeezed here. So the idea is for us to continue higher here. The expectation is for us to continue higher to test this 81.50 level once again. It's shown clearly the 81.50 level comes from the March 31st week. We're stuck, every time we've moved away from this area, we've come right back to it. Ever since we got into this, a lot of trading has occurred here between the 55.25 and 64.50 area. So this is, this is really not behaving. It's going to move away. I think that the market's ready to push higher. Maybe the FOMC will do that for us today. This is the daily profile chart. Every bar represents a day, and then you can see the profiles for every day. Let's thin those bars out so we can just look at the profiles. And this goes way back into February. As you can see here from the profile that's representing this entire area, there's a fair amount of trading that has occurred and it failed to hold below, a nice taper at the bottom. The market's showing less and less participation as price drops. We have a nice rally that came in, started on the 11th, one time framing up, balancing in this 70 area, and then we started to one time frame down Monday, but then we tested lower, like I said, to 44, and then put in a higher high, and we're pushing near highs here again. So you can see this, these bars pushing higher. So we're establishing higher value with the point of control sitting outside of value the prior day. This is fairly bullish. We have a double top at 78.50, 78.75, which is still untouched. That's not likely to last, at least statistically. So the expectation really for today is for the FOMC to cause a push higher more so than lower. That is just my opinion. That is not a trading plan or a trading recommendation. Again, another display of how this move from the low has reacted, the most recent low. You can see we have a strong distribution at the low, so lots of coiling, a lot of energy gathering. That energy resolved itself on the buy side, and then the market basically ran up and has put in a double top at 78.50. 78.75, tried to pull back to 44 and has pushed higher and is holding the 64.50 area. Again, this is a market that's building fuel for the next rotation higher. That is what it's expected over the next, the news week that we have here. Today with PMI, FOMC, tomorrow with initial claims and a couple other things, and on Friday with NFP. The expectation is that the market still has strength in it, probably supported by pretty good earnings. So this is the 15-minute chart of the current course. Again, yesterday shows a pretty even distribution. Overnight traded up to 73.75, traded within yesterday's range, and we're trading right now at 1870 quarter, which was the mid of yesterday, and the value low of yesterday. So if we open in this area, I expect that the initial move will be to try lower first to 68.25, then rotate up to test 72.50, and then to test on this even distribution to test the other side at 74. So that covers our value area here in gray, shown in gray. So 70.50 is value low, 74 is value high, with 72.50 as the point of control. The expectation is we open somewhere in this region, try lower, and then rotate up and start to push through the value area and start to resume our move up to 76.75. That's what I'm expecting as a primary hypothesis. Now, if that does not happen, it actually creates more opportunity. If that does not happen, given the way the market is coiled for an up move, it creates a better opportunity for us to take advantage of some pretty untested structures down below 63, down to 50, 55.25, and 53. The second hypothesis yesterday was a test higher, failure, push lower through to 63.50. If 63 does not hold, then 55.25 and 53.25 are targets. The market ended up testing higher, pushing to the close, pushing through by about 3 ticks, and then finding buyers only to push again out of the Monday range and hold those prices. So the market's behaving very bullish yesterday, even though it didn't go anywhere. It had a pretty decent opportunity to test prices lower. There was a decent opportunity for sellers to hop in and exert influence, and they did not. And so this morning, I expect that the initial test will be lower to put in a secure low, and then start pushing through value and then push higher. The trade is likely to be fairly choppy after PMI. So don't, I strongly suggest that you don't commit all of your bullets, all of the risk tolerance that you have on the trade earlier on. The market's likely to make a squiggle in the morning on PMI, take some direction, and then the longer time frame players are likely to put on their hedges or adjust their positions, delta hedge or options or whatever, ahead of the FOMC volatility. And until the FOMC comes out, we're likely to just end up being in a trader to trader, local to local, or short-term trader type of market until the FOMC release comes out. So it would be unfortunate if you had a daily loss limit and you are in the habit of and you are disciplined enough to hold on and respect your daily loss limit, and then use up all of it in the morning when there's volatility and there's opportunity for gain and loss, of course, that comes with the FOMC, and you have to kind of sit through and watch it happen as the market has the volatility that allows us to take chances and read the market more easily than we can when the market's a local to local, choppy, 2-point range kind of market. So I suggest you don't use up your bullets early. I suggest it doesn't mean you don't trade early, it just means that you understand that you have to conserve some of your ammo for the FOMC later. Okay? I'll leave you with that. Good luck, and hopefully you're finding this information useful. Obviously trade your plan, but hopefully this is helping frame the context of the market for you. Take care.